Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Hey guys, it's Robert from the College Investor here, and today I am excited to talk to you about what the heck are mutual funds and what are the pros and cons of investing in them. Now, even if you have little to no experience investing, I bet you have heard of a mutual fund. Well, a mutual fund is a basket of stocks that are grouped together by a common theme. For example, you might have a tech-oriented mutual fund, or that'll have a variety of tech stocks in it. You might have a bond mutual fund, which will be made up of bonds. And there are many different types of mutual funds to choose from depending on what you are looking for. Investors purchase shares of a mutual fund, which creates a pool of money for the fund to invest. Fund managers use this pool of money to invest and to buy stocks for the fund. And any returns on the purchased stocks are sent to investors, pass through the fund. And this can be in the form of capital gains or dividends. Not all mutual funds contain stocks that have a common theme. Some try to mimic the broad stock market. This can be called index fund investing or an index fund mutual fund. This can mean that the mutual fund contains many funds that have no relation to one another or are well diversified. There's also highly leveraged mutual funds. These funds are typically called 2x or 3x or 10x mutual fund. For example, an S&P 500 2x fund attempts to return 2 times the S&P 500's performance. They also have opposite funds. So there could be a 2x bear market fund, which the S&P 500 goes up, the bear fund goes down. And so there's a lot of different ways that investors can leverage mutual funds to deliver returns for their portfolio. So what is the point? Why would you own a mutual fund? Why wouldn't you just own the individual stocks? I've heard mutual funds can be expensive. Let's dive in. So mutual funds are managed by investment professionals. Even passively managed index funds still have an investment professional behind them. So people who have more experience than you or me are out there managing the mutual fund. There are 2 main types of funds. There's active funds and there's passive funds. Actively managed funds use a unique strategy to generate returns. And this strategy is usually in the mind of the investment professional that runs the fund. And then there's passively managed funds, which are called index funds, like we just talked about, that simply try to replicate the index they're tracking. So everybody's talking about Vanguard, because Vanguard is the largest passively managed mutual fund company in the world. And their founder, Jack Bogle, who is the father of index investing, and he's the founder of Vanguard, had this to say about active versus passively managed funds. Active managers have a philosophy they can win. They come into the office every day and say, "Boy, Mark, I'm going to beat the heck out of you today." And they don't. And when they have a bad year, they'll say it's that year and I'll do it better next year. It's a hard business, and it's not the expense ratios that have to be cut, but it's also the trading. The transaction costs are very high and they're hidden. They're not going to tell you what they are. They are there and they are large. Mutual funds are well diversified. Many stocks are purchased and not just one, so it spreads the risk across a basket of stocks. The more diverse a fund, the less risk it carries. For example, a tech fund carries more risk than a broad market total stock fund, because the tech fund has just a few stocks in it, whereas the broad market fund has many. But a tech fund is also less risky than holding a single stock. Another thing to think about is liquidity. Liquidity isn't typically a problem with mutual funds in most cases. When an order to sell shares is entered, the shares will be liquidated at the end of the day, and you'll get your cash and then a couple days after that. So what are the big cons of mutual funds? Well, fees on mutual funds, especially actively managed funds, can be very, very, very high. A 2% annual fee is not uncommon. And there could also be what's called loads or front-end charges or sales charges. And these are huge commissions that could be paid to the broker that sells you the mutual fund. In our podcast, you might remember a few weeks ago, we talked about how honest financial advisors should disclose their fees. And in that case, there was a financial advisor that was selling mutual funds that had loads on them to his clients, and that was a 5.75% fee up front just for the privilege of owning the mutual fund, which I don't know if the advisor told him, but he was taking 4.75% of that 5.75 as a commission. Just huge fees. It's important to note, though, that passively managed index funds can have super low fees. So when we go back to Vanguard regularly has mutual funds that have expense ratios and fees as low as 0.08%. So that's only $8 for every $10,000 that you invest in that mutual fund. And so that is very cheap. So it does go the whole spectrum. The most expensive investments are mutual funds, and some of the cheapest investments are mutual funds. Mutual funds also can't be opened or closed during the trading day. You have to wait till the end of the day to get in or out of your fund. So if you buy a stock or an ETF, if you place a buy order or a sell order in the middle of the day, it'll execute and it'll happen. But if you want to sell or buy a mutual fund, you put the order in and wait till the day is closed, and then the mutual fund company will execute the order at the end of the day. Also, tax efficiencies have to be taken into consideration. Some mutual funds will distribute capital gains during the year, and you pay taxes on these gains. You might not even know how much gains you're getting until the end of the year, and you might get a huge tax bill because that fund was just selling all kinds of stuff inside of it, and you get stuck with the bill. So it's important to know exactly what you're getting with the mutual funds. However, in my final thoughts here, there has been a broad movement in recent years away from the actively managed funds and towards passively managed index funds, mainly because of their performance and lower management fees. So don't get me wrong, mutual funds are great tools, but you should stick to passively managed index funds. These are more tax efficient since they do not trade as much. They, get really good returns, and they have low expenses. So now that you kind of know exactly what mutual funds are, you are armed with this information and you can go out and feel better about your investing decisions. Hopefully this made sense to you. You can always read everything on the blog. If I went too fast or you missed something, you can go to thecollegeinvestor.com/episode 55 and you can learn more. All right, guys, thank you very much, and I'll talk to you next time.